Business FM, Dubai's home of business radio.
It's the morning drive. Fresh tensions between the US and Iran are rattling global markets once again, raising fresh questions about inflation, about interest rates, and where investors should put their money next. As geopolitical risks return to the spotlight, what should investors expect in the weeks ahead? Lots of questions to ask Ryan Lamond, who is the founder and CEO of Neovision Wealth Management, joining us with insights on navigating today's uncertain market landscape. Ryan, welcome back. Good to have you with us again.
Good morning, Tim. Thanks for having me. It's a pleasure to be again.
It's a pleasure to have you. Welcome back. So we've seen Brent crude experience immense volatility. The global supply chain is absorbing some pretty big shocks from this conflict. From a wealth management perspective, now that we're nearly just over 4 months in, can I ask you a similar question to one that I asked you some months back? Is this a temporary knee-jerk market reaction, or are we looking at a fundamental regime shift in terms of the market volatility we're experiencing?
Well, there are multiple facets to the story. The first one is the energy shock has taken place. That's it. And in our opinion, this will translate into a spike in inflation, which we are starting to see. And the Fed is starting to react to it. We've heard Waller on the Fed board, who mentioned an interest rate hike. I think any reduction in interest rates by the Fed is off the table completely. And now we're talking about increasing rates by the Fed. So the energy shock has taken place. Now we're living the aftermaths. Now, regarding oil prices, that's a very interesting point. We've seen the détente that happened, the discussions of the MOU between Iran and the US, and oil prices dropped. So everyone thought, this is it, it's over. However, what dropped is simply the screen oil price, the paper price of oil. This is not the actual price of oil that you have to pay to get an oil barrel delivered to your home or to your industry. This is just simply the screen price of oil. And the proof to that is if you look at gas prices in Europe, US, and multiple other countries, they remain quite elevated as if oil was trading at between $90 and $100. So we shouldn't be fooled by the price of oil that we see on screens, because it's not the actual price of oil for the consumers. Consumers do not buy paper oil or screen price oil. They actually buy gasoline for their cars. And that price remains very elevated. And this translates into the inflation spike that we are expecting.
So, oil prices react really very sharply, of course. I mean, this morning in Asian trade, Brent crude's up just under 1%. It's about 83, 87, or it was when I looked a little while ago. US traded oil was a little bit higher than that at just over $79 a barrel. That's after more than a 9% jump in the price of Brent on Monday as the conflict was, seemed to be escalating. So the natural next question to ask you is, how long could this volatility last? I feel like I've been asking that for the last 4 months. I might as well ask you how long a piece of string is, right?
Well, when this whole war started on the 28th of February, we all thought this is going to last a week or two, just like June of last year, and some sort of an agreement will be reached. It's just negotiating with a few missiles. However, now 4 months down the road and war clearly having started again, with President Trump talking about even tactical nuclear bombs used in Iran. The missiles that we've seen being exchanged between Saudi Arabia and Houthis in Yemen. So clearly war is starting again. We've also seen Trump writing to the Congress, informing Congress that war has started with Iran, which gives him a 60-day window for another military engagement with Iran. So this is no longer geopolitical tension. We're back to missiles. President Trump announced also last night that some bombings will happen in Iran today. So yes, I think war has started again. How long would this last? Again, we thought it's going to last two weeks. We're 4 months down the road. I wouldn't be surprised this lasts until the end of the year. So volatility is expected all across the board, oil, stocks, and inflation spike. Unfortunately, wars are inflationary.
I mean, President Trump has, there is a proviso in all of this that he said that a deal still can be made, which is a mantra, I guess. Ryan, you're an expert in fixed income, in quantitative asset allocation. One of the issues we're seeing right now and experiencing is that of financial contagion, bred and I suppose even fed by the uncertainty that we've all been going through. Can you put into context how shocks in the oil market bleed into everyday stock portfolios?
Absolutely. It's actually a very straightforward mechanism. Energy prices go up. This feeds into everything related to logistics, transportation, and then feeds into the end product. Once it feeds into the end product, this is what we call an inflation spike. It's a direct supply side inflation shock, as opposed to demand side inflation shock. Demand side is when consumers start buying a lot of similar products, and this is what drives up prices. This is not the case. Today, it's a supply side inflation, which is very, very hard to fight, actually, as opposed to demand side inflation. So once we have this spike inflation, which we are living today, we're seeing it. PPI is above 4.2%. This is when the policymakers have to react. And they react generally by increasing interest rates. Once they increase interest rates, funding rates, what we call funding rates, increase, which means the rate at which companies borrow money to finance their operations, which means their cost base increases and they have to increase even further the price of the products they're selling. So basically the victim here is the end consumer, because everything is passed along to the consumer. And just as a parallel, the tariffs that President Trump has imposed, which have been reversed by the US Supreme Court, now had to refund $81 billion of tariffs to the countries from which these tariffs were collected, which means that the US consumer has actually paid for this twice. The first time through the product, when they bought it at a more expensive price because of tariffs, and second, by financing these $81 billion through debt. So basically, the cost of borrowing increases as a direct implication of the energy shock that we're living at the moment.
You've written extensively on financial contagion. You argue that the rapid global integration has made market shocks more pronounced than ever. We're constantly told that staying invested is the best policy. Markets generally tend to move northwards over time. But as contagion becomes more rapid, it's more widespread, is that advice losing its validity? I mean, how do you reconcile the academic advice, if you like, of wait it out, with the reality of a market that's now moving at this increased speed of global finance?
So there are two aspects to this. The first one is contagion, as you rightly mentioned, and this was one of the subjects of my PhD, actually, how to measure contagion between financial markets. Contagion can be managed, okay? However, when you combine financial stress or financial volatility through contagion with inflation, things become quite complicated. Because inflation, what it does, it eats up the cash value of your money. So if you have $100 at the bank and you're not earning any interest on it, any revenue on it, in 1 year's time, this $100 is worth $96. So you've lost basically $4 in 1 year without doing anything. So to fight that, you have to remain invested to fight that inflation, which is spiking right now. So you have to invest into financial assets that generate return. And this is where we get to the contagion part. If you do invest into financial assets that are very, very volatile and could lose value over time and could fluctuate a lot, this is when you could end up losing more than the $4 that you would have lost with just inflation of 4%. So here, the best advice I can give is stay away from all financial assets that are overvalued, because overvalued assets are generally the ones that suffer the most during periods of stress.
Can we talk about inflation in a little bit more detail? I mean, central banks were already in a delicate balancing act with interest rates, and now with energy and transport costs surging because of maritime blockades, derailing expectations for rate cuts. How severely does this crisis complicate the inflation outlook? Should investors expect rate cuts to be completely off the table for the near future?
Oh, completely. Absolutely. It's completely off the table. And one of the issues is the United States, where the US dollar is the reference currency, and many currencies are pegged to the US dollar. And these countries who are pegged to the US dollar have to increase rates as the US increases or maintains its interest rates. Now, the problem with the US is that interest rates are relatively high at the moment, and could be increased because inflation is going up. But the second side of the equation is that on one side, monetary policy, the Federal Reserve's balance sheet is today more than 20% of the US GDP. So basically, the Federal Reserve, on one end, has interest rates high, but on the other hand, has very loose monetary policy. So this is a contradiction. So one is fighting inflation, and the second is boosting stock markets, giving wealth effect to consumers. The other aspect of it is fiscal policy. If you look at jobs created this year, 2026, 58% of US jobs created are 58% of jobs created in 2026 are government jobs. So this is basically a very loose fiscal policy, which is pumping money into the economy. So this is the same policy that was adopted under President Trump. So today, the US economy is living off the government spending, whether through the Federal Reserve having a loose monetary policy, and on the other hand, the government, which is hiring government employees to boost employment, who ultimately spend. All of this is financed through what? Through issuing more debt. So today, if you look at the debt numbers of the United States, it is absolutely staggering. 42% of all taxes collected by US government, 42% is paid on interest servicing. So basically, the US debt at the current interest rates is consuming 42% of revenue from tax that the US government is collecting. So this is the biggest problem that I think the world is facing.
Ryan, let's move back towards the Gulf slightly. You're rooted, I mean, both personally and as Neovision, you're rooted in this region. Local markets are right on the doorstep of the crisis at the moment. How are regional equities and fixed income assets holding up compared to Western markets? Are you seeing institutional capital move differently here as well?
It's more prudent, obviously, because we are in the region where this war is happening. Obviously, the Strait of Hormuz is a very important maritime passage, so it gets a little bit more difficult to get certain products. However, thanks to the United Arab Emirates specifically having the eastern shores, where there's the Fujairah port, for example, the United Arab Emirates is able to export record amounts of oil. And this is obviously very good for the US economy and the US companies ultimately. And that is why financial assets have held up very well. And I can tell you from my side, we have two companies in the UAE and we're operating completely normally. It's as if there's no war in the region. Investors are taking investment decisions regarding their projects in a completely normal way. And I think the UAE's economy is operating in a relatively normal way. Obviously, there are less tourists than before. This is a natural extension of having geopolitical tensions in the region. But otherwise, I think from a day-to-day perspective, from a financial and economic perspective, things are completely normal for us. It's BAU.
It's a more positive response to hear. Let's talk about strategy for the retail and maybe the mid-tier millionaire investor, Ryan. When a crisis like this hits, the instinct for many is panic sale or rush entirely into gold, into cash. What's the smart, calculated move right now? Which asset classes act as true safe havens today? And also, I guess, what should people be trimming from their portfolios? What was your advice, if you like, at the moment?
So my first advice, as I mentioned before, is stay away from anything that is overvalued. This is what suffers the most.
Right.
Second, try to go to geographies and industries that are decorrelated with whatever is causing the current stress. And I've mentioned it before to you. For example, Swiss equities. So Swiss stocks, where mainly it's two main sectors, pharmaceuticals and chocolates. So consumer products. So Swiss equities have done very well. Swiss franc is a very solid currency. This is where I am personally mostly invested and for years now. Second, geographic and asset allocation diversification are extremely important. So cash sitting could be invested into US treasuries, mainly the short end, like the 2-year treasuries, for example. This will get you 4 to 4.2%, which is not bad on the cash side. On the stocks, again, go to decorrelated, isolated, real fundamental stock markets relying on real economy sectors. And 3, obviously, precious metals like gold are extremely important in a portfolio. And let me just give you one number and allow me to ask you a question. I'm going to give you 3 investments. 1 is Swiss equities. Second, it's the S&P 500. And 3, it's gold. The 3 of them over the past 12 months have gone up by roughly 20%. So in hindsight, which ones would you have selected among these 3? S&P 500, gold, and Swiss equities, knowing that they will perform the same way, 20% up in 12 months.
Oh, that seems to me to be a triple-edged sword of a question. I'll be honest with you. But you know what I'm going to answer? I'm going to answer with your advice, which is Swiss equities, and I am a chocolate fan, and that's the reason.
Here you are. S&P 500, if you look at all of the ratios and all of the valuations, they are through the roof.
Yeah.
They are higher than what we have observed in year 2000. So yes, the choice is obvious.
What about technology? How much exposure to technology? I mean, the discussions that we have around AI are rampant at the moment. It's almost dinner party conversation. I guess it is to some extent, really. But how do you view technology stocks right now?
So I have a PhD in applied mathematics. I worked on models called neural networks back in 2001. This is what we call today AI. I obviously believe in the modeling. I believe in AI. I believe in this technology. However, how it's being done in the United States, well, pushes me to question it a little bit. You have 2 sides to technology in the United States. You have the hyperscalers and you have the semis or AI companies. Hyperscalers are investing staggering amounts of cash into semis and AI companies like ChatGPT, OpenAI, Anthropic, etc. Okay, so hyperscalers are the very cash-rich companies pouring a lot of money into AI companies. Let me give you a few numbers. My monthly subscription to one of these AI companies is $200 a month, which is the highest subscription they offer. Right? Year to date, since the beginning of 2026, I have consumed the equivalent of 1.2 billion tokens, okay? So roughly 200 million tokens a month. So 200 million tokens a month, the actual cost of it is $5,000. So I pay $200 for something that is costing $5,000. So I'm consuming $5,000 for the price of $200. Who's covering the subsidy or difference? It's the hyperscalers who are investing a lot of cash in Anthropic and OpenAI and other AI companies. This is unsustainable. And we're starting to see some victims like Oracle that got downgraded by S&P 500 and it's BBB minus, very close to junk bonds. As opposed to China. China today has a different approach to modeling, which is not reliant on data centers. Okay? They are reliant on small language models, which are installed on your own PC. So there's no gap or subsidy as the one we're seeing in the United States. Until this gets resolved, I prefer to remain prudent from an investing perspective.
History shows that geopolitical crises also create deep market dislocations and buying opportunities. So if someone has dry powder, cash to deploy, where should they be looking to capture value once the dust begins to settle, or perhaps earlier, Ryan?
Looking at fundamentals. You have to look at fundamentals and valuation metrics. So today, if I had to look, I would dig deep into the 2,000 companies onto the Russell 2000. if we're talking about the US markets, obviously. The Russell 2000 has 2,000 companies, small to medium sized. Some of them are family owned, or family managed. They are positive cash flow. They distribute dividends, and they have valuation metrics that are literally on the floor. Okay, so they are no-brainer purchases. So this is where I would dig deep. If you look at a period of 30 years across roughly 30,000 stocks in the United States, only 27% have overperformed the index, the S&P 500. And which ones are these? Are the ones that are fundamentally very sound and that are not overvalued. And this is where investors should dig into. Now, obviously, for retail investors, it's harder because we institutional investors, we have the tools to scan and classify these stocks to find them. However, today with AI tools, it makes it a bit easier to do so. So always look at fundamentals and stay away from the hype.
Investing is a very personal thing. It reacts in a very human way. You know, sentiment is a thing. How do you advise investors to balance opportunity with risk in an environment as uncertain as the environment that we're experiencing right now?
Again, fundamentals. Hype, feeling where the herd is heading is not the right way to go. We've seen it multiple times across history, across bubbles, across hype periods, where people lose a lot of money. So if you look at year 2000, when everyone poured money into specific companies, one of the best US companies today called Microsoft, okay? Microsoft took 12 years to go back to the same level it had back in year 2000. 12 years. So pouring money today into overvalued companies, and we see a correction, it could take literally years for that investment to go back to its original purchasing price. So investors have to be very, very prudent when investing into overvalued stocks and following the herd.
I guess if there's one thing that history teaches us, it teaches us that more often than not, we don't buck the trends, do we? We go with them. And in some ways, we just never learn.
Absolutely. And the problem is something called the wealth effect. So let's say I bought NVIDIA 2 years ago. I would have made a lot of money. And my money would have still been invested into NVIDIA. So I feel very wealthy, right? I look at my investment portfolio and I see it grew 200-300%. So what I do, I start consuming more, spending more money that I don't yet have. And let's say there's a correction today, war expands, and NVIDIA drops through the floor. So the unrealized profit that I had made on NVIDIA would be gone. And all of the cash that I spent because of that wealth effect that I felt is also gone. And this is what many investors have gone through in multiple cycles across history if you look at the psychology of investing.
Just a couple more questions for you. I'm interested in really just your, not advice, I don't want to pitch it that way, but just your thoughts. So advice style questions, I suppose, really. What's the biggest mistake that you see investors tending to make during periods such as the period we are currently in, geopolitical tensions, uncertainty, volatility?
Well, it's barbells. You have one side investors who sell everything and sit on cash. Geopolitical tensions and wars are inflationary. So over time, the time value of money kicks in and it's ruthless. It will eat into that cash very, very slowly. So they tend to stop trusting banks, stop trusting any investment, and they just sit on cash. This is a mistake. The second, on the other side of the spectrum, is investors starting to pour money in a very concentrated fashion, focusing on just a small handful of companies in one specific geography. This is also a mistake. It could win big or it can lose everything. So it's really binary in that case. And I think both sides, it's a mistake to do it. Somewhere in the middle, geographic diversification, asset class diversification, and looking for adequately valued assets is the best approach.
Final question for you. If an investor changes one thing about their portfolio allocation today to, protect themselves, if you like, from risk, or in some way to protect themselves against risk, what should that one thing be?
That's a tough question. If it were me, I would reduce my exposure to US stocks today.
Okay. I appreciate your time, Ryan. It's always good to hear from you. Founder and CEO of Neovision Wealth Management, Ryan Lamont, giving us a blueprint to hopefully bulletproof our portfolios. Appreciate you joining us once again. Thank you.
Thank you very much for having me, Tim.
It's good to have you on the show. Don't forget to like, follow, and subscribe for more interviews and content like this from Mira Business FM.
Mira Business FM, Dubai's home of business radio. Business FM.
It's the morning drive. It's real estate next. What is your plan B is the topic this morning. AJ Menon is back in the room. He's the CEO of Lux Vista Real Estate. We've just been talking about man caves and bat caves and basements and all the stuff that boys do. That's going to be a topic for soon, AJ. We've got to revisit this.
Definitely. The evolution of basements in Dubai.
Oh, I tell you, that's coming. But right now, you're just back from Georgia.
Yes, Mira Developers was kind enough. They had taken quite a few channel partners to Georgia to launch their Mira Hills project on Tbilisi Hills. That is their equivalent of Emirates Hills. It's perched on a hill with a golf course looking onto the city.
I've seen some of the pictures of it. I don't know much about it though. Obviously, they're the parent company of us. Lots of things going on, but this is a big old thing, isn't it? It's a massive project.
It is indeed a massive project, actually.
Yeah.
And this is something that Georgia has never seen before. The Georgians, they have the local developers build and give shell and core units.
Yeah, okay.
And this is where Mira is coming up with a 5-star hotel, branded residences, fully furnished, fully fitted, completely serviced units.
Yeah, okay. It's interesting actually. Georgia as a place to go and ski is something I know a little bit about. A friend of mine had bought an apartment there. I don't know, it must be 15 years ago, and because she was really into skiing, would go maybe a couple of times a year. But it's becoming a more and more attractive destination, isn't it?
That is correct.
Yeah.
So I simply thought, why Georgia? It's like, and then it's simply not. It's not a coincidence. It is very strategic, and Mira is not the only developer who's out there.
Who else is there?
The biggest private developer in the UAE. And
Okay.
one company which is completely owned by Mr. Mohammed Al-Abar, not Imar, completely owned by Mr. Al-Abar.
He's also developing
He's also developing in both Batumi and Tbilisi.
Okay, so you've now been there. First time?
No, second time. I've been
Second time there. Okay, so now that you're back, you've had a little bit of time to reflect. I was going to ask you why Georgia. I don't mean that to sound patronising in any way, but what was it that is actually so attractive about?
Yes,
Georgia?
I'll tell you why. Because obviously I started digging much more deeper into why Georgia has been, preferred by these UAE developers in particular. It is not a coincidence. It is very strategic. Quite a few reasons. Number one is basically the prices. Georgia is probably at 20 years where Dubai was. When Dubai was 20 years, Georgia is now that. So developers can get land at a cheaper price. They can develop it much more. It's still priced very lower than other European capitals. Lot of not just construction margins. Developers can actually expect returns on the whole price differential.
Okay. We've all heard the buzz about Tbilisi. Georgia's becoming a more and more popular tourist destination. I think
Tourism is off the roof.
Yeah.
Getting a lot of interest so tourism is actually one of the biggest income drivers in Georgia.
Okay.
So if you look at Batumi is more like your Dubai. It's the beach vibe and the marina and those kind of things. And Tbilisi is more like Abu Dhabi. It's basically a city break, the capital. Businesses coming in, so you've got both aspects covered in that.
Okay, so when when you fly into a place, I always do this. When I fly into a place, I always sort of think, because I like the idea of city breaks. I've done quite a lot of that. And you fly in and you spend the first kind of 24 hours getting your bearings. I usually do like a bus, the bus tour, and I kind of work myself out. But you know pretty quickly when you fly into a place whether you feel comfortable, whether it's the place for you for whatever reason. Doesn't matter what that is. When you fly into Tbilisi, is that how it works for you?
It's a very small airport, so very easy to come out. Obviously, everything was arranged, so it was much more easier. But even if it was not arranged, it's a small city, small place, very close to the airport. So things are very easy. And when you actually go into the city, it's unlike Dubai. There's a lot of tree-lined boulevards. The weather is fantastic. you feel at home, and then it's like your the shops are on the streets. You can just walk out. It's a very comfortable feeling.
Yeah. Okay. Okay. No, I'm just trying to get a feeling of I think the kids call it the vibe, but there's something important about that. So you can see why people are attracted, and you can see it gives you a good feeling of the way it will develop because it's comfortable. Does
And
that make
I've
sense?
got one more strong driver. In fact, my
here we
wife
go.
fell in love with this place, and she wants to buy one there.
Really? Yeah. Okay. Yeah. Okay. Well, rookie mistake. Let me tell you. So you toured what? It's Mira Verde, is that right?
Mira Business, yes.
Okay, so this is as you pointed out, it's a total departure from the kind of shell and core thing that we see here, or the other developers in Tbilisi doing, in Georgia doing. So branded, fully furnished.
Fully furnished, fully fitted, along with a lot of services. We are talking about housekeeping services. We are talking about valet services. There is an AI school, hospital, you name it, they have it.
Chef services,
Chef
all
services,
that kind of
yeah.
thing.
So
Yeah, okay.
It's like where the posh people go and then just relax. It's a plug and play option. That's what they're offering.
So do you think that could be at the future of international real estate, that kind of hotel style, sort of residential model hotel aspect thing? Or is that just a way to solve the lack of like local fit out infrastructure?
That is very important, because if you're sitting somewhere outside the country and then you're buying a property just to invest it, and then you don't really have to go through this whole fit out thing, you find the furniture, go to the local shops. It's a big headache. And here you don't need it. It's just, you just buy, Mira will rent it out for you, and that's about it. You don't do anything much.
Okay. So, I mean, a lot of people would look and think, look, I don't really know much about Georgia. I've heard a lot about Dubai. So, if you don't know much about something, you see it as being riskier, I suppose. That's natural. But when you look at the growth stage, it kind of mirrors Dubai in the early 2000s, a couple of decades ago. You've said that. It's a market that feels like Dubai was then. It's a comfortable market. If you miss the boom time here in 2005, 6, 7, that time, is Georgia like the closest time machine we've got? Is that kind of
At the moment, that's what I feel like.
Yeah.
And that's what I've experienced in the last few days. And it's very business friendly. Foreign ownership is permitted. Very low taxes. We're talking about 5% on rentals.
Yeah.
You also have residence permit options. So if you buy a property and hold it for 5 years, you can apply for the residence permit.
Okay.
So that actually sorts a lot of problems for a lot of other countries.
But I guess in risk terms, I mean, it's not for everybody, but then,
It is indeed a high risk, high reward kind of a thing.
Yeah.
The main risk factors that I see is basically domestic population is quite small. We're looking at around 3.7 million people.
right.
And the domestic purchase power is small, is less. So these kind of products are mostly for rich Georgians, international Georgians, and international community.
Right.
So if I were an investor, my target clientele is basically the Russians, the CIS countries, citizens of CIS countries. We're looking at Turkish and Indians.
Okay.
Why Indians? I mean, I was quite surprised by looking at the buyer profile, because there's a lot of Indian students looking to study in Georgian universities for PhDs and medicines.
Okay.
And once the Indian starts coming, they will set up a community, they will build roots there, and no amount of real estate is, is enough for the Indians.
No, I guess so. But it isn't only about the golf course community idea, is it? I mean, that's not. I mean, it's very attractive. UAE developers are playing a long game.
Yes, and Mira makes a lot of sense, because what they're giving is they're giving you a 8% ROI for 10 years, and also buyback options. So this actually solves a lot of problems for me, because your exit plan is already taken care of. Because my issue with any investment is, how do I exit with a profit?
Yeah.
So if Mira is giving a solution for me, then it's a no-brainer.
Seems to be. But what is it that the developers here can see? Because these are master-built communities, right? What do they see in the macro data? Is this purely about property? Is it to do with Georgia as a logistical gateway? It's a gateway to Europe, but also to Central Asia, isn't it?
Definitely, and that is actually a very growing market. We are looking at Georgia's location is very interesting. It is between, there is GCC, there is Central Asia, there is the Europe. It's somewhat sits in between. So the land-based transportation, it's going to be a logistic hub. When that comes in, there will be a lot more demand for residential and commercial properties. So I can see that market growing quite a lot.
Okay. And I was looking at some of your notes that you sent. Have I got this right? $100 same-day registration, property registration fee versus what? Dubai is effectively 4%.
Dubai is 4%, Abu Dhabi is
Yeah.
2%, yeah.
Yeah. So if you don't like the bureaucracy of mature markets, that's pretty good.
And if you want to stay for 4 days, enjoy Georgia, that reduces to $70, the
Really?
registration fees.
Okay. So we said at the top of this, what's your plan B? If you're looking to, obviously, meaning if you're looking to invest in real estate, is Georgia like a primary, it's like plan A, I don't know.
It's a
point
plan
two
B
or
plus.
something.
It's a plan B plus, I would say.
Right, okay. Okay. Plan B, the reboot. So 5% rental tax, low cost registration, as low as $70, as you say. There's also the residency path,
The residency path is very important for especially Indians.
$150,000. Is that right?
$150,000 worth, and you need to keep it for 5 years.
Right, okay. So a rational diversification move, you could argue.
Definitely. And this is why the GCC guys are more interested now. I can see a lot more renewed interest in GCC because of this conflict situation.
Yeah.
And when they are seeking to diversify, Georgia is pretty much right on the top.
Yeah.
Not for the extremely rich. Obviously, the extremely rich can go anywhere. We're talking about Miami, Milan, Singapore. Okay, that's a different class. But other than that, if you're looking at the top 10%, not the 1%. Forget the 1%. If you're looking at the 90 to 99%, this is a good option. Or even 85 to 99%, Georgia would be a great option.
Okay. So let's get down to brass tacks a bit. Let's be real. So the UAE market is liquid. It's a deep market. The Georgia market, obviously, much thinner, I suppose, much shallower. How should an investor manage their expectations? If you're looking for a 10-year hold with buyback options, is this a set it and forget it investment, or do you need to be sort of boots on the ground?
You don't need to be on the ground. I mean,
Don't at all.
it's like an asset that will perform. It's a financial product actually, term disguised as a real estate option.
Okay.
But if you want to go and live there, that is also possible.
Right. So Mrs. AJ.
Batumi.
what's the
She wants
code?
Batumi,
She
yeah.
wants Batumi. The thing is, there's nothing like actually being there, though, is there? When you get a feel for a place, for a property, get a little bit of local knowledge going on. Having seen Tbilisi being pointed in the direction of Batumi, you've experienced some Georgian culture a little bit. How do you feel about potentially making an investment there? Yourself, I mean.
Well, I've got compelling reasons to invest, but if I as a person, I've already invested in UAE, so I'm exposed to UAE market.
Right.
So I don't mind investing in Georgia because that will be my diversification strategy. Okay. And I would not go for Batumi. I would go for Tbilisi because that I like that place. I mean, I don't know much about. I am not really into beach and yachts kind of a thing.
No,
myself,
you're a city guy.
So I'm a city guy. So
Yeah, okay.
and this is like, you have a little bit of golf course and city and, on the hill kind of a thing. That's my vibe.
It's kind of stepped on the hills, so the way it works. I've only ever seen the pictures, but I suppose if you think from a commercial perspective for Georgia, looking forwards, it's a pretty rosy future, isn't it? There's so much interest.
It is, and I was quite surprised. There was a lot of food options, restaurants. I found a lot of Indian restaurants. I even found South Indian restaurants out there. So even before the market is just started, but I can already see that there's an established community, especially an Indian community out there. And I saw Chinese restaurants. I saw a lot of other Italian restaurants. You name it, they have it.
So it's all there.
Yeah.
I mean, if a place doesn't have an Indian restaurant, you have to regard it with suspicion.
Anywhere in the world, you will find Indian and Chinese restaurants.
Well, where I come from, it's our national food now, as we've said many times. So it's 4-hour flight, is that right?
4 hours flight. My only complaint is basically they only fly Dubai. I would love to have Emirates Airlines.
I was thinking about that. Yeah, so lack of national flights by some of the major carriers, but you could also look at that in a different way, couldn't you? That's like an opportunity. So if you're an investor and you can only get there, there's nothing wrong with Fly Dubai, don't get me wrong, but if Emirates don't go there directly, you're getting in early.
Very much.
I
This is a
suppose.
very early phase.
That's the point.
And that's the point. When I look at it, I'm looking at it from the lens of an investor.
Yeah.
So I see completely the whole the platform is there, and it's just developing. The developers themselves are going now. So I'm in with the developer right now.
Yeah.
Early stage. It doesn't get earlier than this.
Yeah. No, that's exciting. Tell me about the journey was it from the airport to...
That's another thing. Terminal 2, I'm not really happy with the Terminal 2. So we have to go to Terminal 2, take the Fly Dubai, and then, land there. There it's fine, but the whole Fly Dubai angle is because I have to go through the Terminal 2. Call me snob, will you? No, but I just love the original Terminal 3.
Yeah, fair enough. What about the journey when you got there? You got in... you said something about getting into a car.
Yeah.
Can you tell me about this? Can you tell me some of the secrets?
It was not there. It was basically when we were being taken to the site.
Okay.
Obviously, the Mira had arranged everything, logistics, transport, the whole thing.
Right.
And they just asked me and my wife to get into a car, and I happened to get into a car with somebody way high in the Mira food chain, one in the C-suite level.
Oh, really?
Yeah, and that 20-25 minute the car ride to Mira Verde gave me almost 2 hours worth of or 2 years worth of research information in all of UAE, the real estate market.
Okay.
These people have got access to everything, all the information, all this, the management consultants working for them, the reports, the reviews, the future.
Yeah.
Mira definitely is coming with a few master developments in the UAE.
Yeah.
We're talking about Mira Hills and Abu Dhabi. Apparently, there is something coming up in Ras Al Khaimah, a master community, not an individual building in Marjan, a complete master community.
Okay.
And he told me a ridiculous number, which is very, very, very cheap. Starting prices of 700,000, apparently, for a fully furnished property coming up in Ras Al Khaimah.
Okay.
That is going to be a game changer there.
Okay.
Then he also said that they are looking to expand into 20 plus countries in the near future. I cannot tell you all the information will come from the official channel, but I can only hint that some of the things that he mentioned. The one thing that remained in my mind was apparently Uzbekistan had 12 million the tourists last year, and this year they're expecting anything between 12 and 15 million. Whereas Dubai had 19 million tourists last year, and this year it might be dented because of this conflict.
Because of the situation, yeah, for sure. I mean, but that's the point, isn't it? The scope of what's coming, not just Georgia, but Uzbekistan, other emerging corridors.
I didn't tell you that there's something coming in Uzbekistan. I just told you that the tourism numbers in Uzbekistan.
No, but I mean... That's not without reason, is it? Let's face it. But if you compare those markets to where the UAE was even, 5 years ago, are we entering a decade where the Middle East developer becomes the primary driver of emerging market real estate? I mean, it looks that way. It seems
that because they have seen that the Dubai market works, so they're pretty much copy pasting the whole thing, and it's like they have a complete ecosystem done. It's just copy pasting it into a different country.
Which makes a lot of sense. I mean, if it ain't broke, don't fix it.
Exactly. They're not reinventing the wheel. They have the structure. They know how the system works. And they just, when these people are going in, they're going in and doing joint ventures with the government, with the local government. So it is a private-public, joint venture kind of thing, which makes sense for their economy as well. They understand this. So when these mega developers are going there, they're getting carte blanche.
Yeah. Okay. No. That also makes sense. So is that kind of, you start to see the joined up thinking, don't you? And the joined up writing as well, and all of the things that sort of fit together. So, final question for you then. You liked it. You felt comfortable. If you have a diversified portfolio in Dubai, should you be putting your next $200,000 into a studio in Tbilisi or Batumi, or are you going to wait for the market
That's
to
the beauty.
mature?
$150,000 is for a one bedroom, not a studio.
Oh, there you go. Okay.
So now you know the numbers.
I'm living in Dubai.
So you are
AJ.
getting
What do
you are
know?
getting a one bedroom for a price of studio in Dubai.
Okay. I'm getting a bit ahead of myself, but very attractive, and you enjoyed it. It was a good trip.
It is a very good trip. Yes.
Okay. So what are we doing next week? Are we going to do basements next week?
I don't know. I've not thought about it. We
You
just had a
haven't thought about
chat
it yet?
today,
Okay.
so let's
We
see.
should I tell you, there's something about the man cave, the basement, just the idea of having a pool table in the basement.
Not just a full table. We're talking about foosball tables. We're talking about poker.
The screen. Yeah, I know, the whole bit. No, I'm with you. I'll see you around at your house. AJ Menon, CEO of Lux Vista Real Estate. It's always good to talk to you.
Likewise, Tim.
Appreciate it. Thank you. Stay up to date with all of our interviews and associated content as well via mirabusiness.fm.
Mira Business FM, Dubai's home of business radio.
It's the morning drive. Fresh uncertainty is hanging over the Middle East after the latest escalations between the US and Iran. Even as both sides signal they are still open to talks, and with investors watching oil prices, shipping routes, and regional stability, the big question is whether diplomacy can still deliver lasting peace and restore business confidence. Joining us is Dr. Zaidon Al-Kanani, founding director of the Arab Perspectives Institute. Hopefully we can get some insights on the outlook for negotiations, for regional security, and what the latest developments mean for businesses and investors. Dr. Zaidon, good to have you on the show. Thank you for joining us.
Thank you very much. It's a pleasure to be here.
We've seen a pattern of fire followed by a truce, followed by renewed escalation. Is this latest round of talks, or has this latest round of talks in Oman been fundamentally different, or are we witnessing a tactical pause, if you like, while both sides catch their breath? What's happening now?
Well, to be frank, the MOU, which did derive out of these talks, were never seen as a permanent solution from the first place. It was seen as a temporary ceasefire, if you may, that would have calmed down the escalation that was unexpected by all sides involved. It was also an attempt, as you rightfully mentioned, where there would be internal assessments by all parties, figuring out how to return to the situations if it were to revive again, as we are gradually noticing now. But this doesn't mean that all sides in this conflict are not interested in stability or a solution. I think it has been very notified and recognized from the early stages of this conflict that even both the United States and Iran, alongside the regional actors that have been impacted by this war, have been wanting and putting enough effort into wanting to end this war. In fact, there was a stage where we noticed that the days of the negotiations preceded the days of the conflict. I think the multilateral element of this war is what is complicating it, and that is due to the Israeli presence and element. This is also a notified issue by all Gulf countries that are arguably long-standing allies of the United States, economically, commercially, politically, institutionally, educationally, and in many different industries. It was perceived that this conflict had only aligned with the Israeli approach towards the region, which made it very odd for many Gulf actors in the region, including those that were close to normalization with Israel. So these talks seems to be that they will continue to be ongoing, given that most countries affected by it geographically and involved in it politically are impacted by it in one way or another. However, it seems like there will be a permanent scar in the relationship between the United States and many regional actors.
It does seem that way. It's very hard to read whether these latest escalations will ultimately lead to a strengthening in the resolve to find meaning in the talks, or if they're weakening the prospects for that. The Strait of Hormuz is to market confidence is key. Iran has signaled it values control over the strait more than avoiding renewed conflict. For a business leader in the Gulf, how do we interpret this? Are we entering a long-term era where maritime transit through the Gulf is permanently conditional?
I think business investors wouldn't have to be concerned about the legal mechanisms that would erupt out of this war when it comes to the Strait of Hormuz, as much as policymakers would do. What this war has mainly conducted or created is that it has been transforming from something called the Iran war into the war on the Strait of Hormuz. And this comes as a sudden surprise by most parties involved, given that it was clearly not in the calculations of the US administration when they were imagining and planning for this war. It was also not in the calculations of many Western allies that feel like they didn't put enough effort in advocating against this war for happening, similarly to the Gulf efforts that were attempting for this war not to happen, despite their share of differences with the Iranian government and regime. I can imagine that business investors would now want to look at already existing industries or emerging industries that would derive out of this conflict as a form of economic resilience. We've noticed throughout history, even particularly in contemporary history, that certain political crises, and not even necessarily wars in this type of scale, would allow many economic circles to notice gaps in the market that would be beneficial. I think finding alternative routes and trading routes for businesses to survive isn't a concern that would be a burden on the shoulders of business investors. That is a concern that will have to be dealt with policymakers.
Reports do suggest that the conflict has, in the words of one report, irreversibly shaken the image of the Gulf as a safe harbor for international capital. How do you read this? From your perspective, is this just a temporary reputational dip, if you like, or are we seeing a fundamental shift in how global investors view the risk premium of being based in the Middle East?
Well, I think many countries have picked themselves up from much more complex and intense economic crises in the past. One cannot forget that this is the very same global economy that has survived the global financial crisis. It's the same global economy that survived the economic crises that many European economies faced following Brexit. This is the same global economy that has survived and bypassed the consequences of COVID-19. A lot of people would obviously counter-argue this point that we didn't necessarily survive. Inflation has become enormously difficult and has only made it even harder to many low-income and low-middle-class income communities around the world. Even this part of the world has dealt with its fair share of many political developments throughout its contemporary history. One cannot forget the challenges of the Iran-Iraq War in the 1980s, the challenges of the Gulf War around between 90 and 1991. In fact, countries such as Iraq, that were one of the most war-torn countries since the US invasion in 2003, is now seen as a country that is picking up itself economically, and even many Gulf investments have been entering the country. So I think it might be too early and too unfair to judge and assess already about a war that we don't even know the future of it. It might end next week and it might take another few months. That this war would completely eliminate the economic standards of the Gulf region. We also have to keep in mind Gulf countries are 6 different polities, 6 different sovereign states with very diverse economies, very different geographical sizes, very different interests in their investments in natural resources. I think what's mostly concerning about the future of the Gulf region is imagining the transnational alliances, if there will be any reshuffling alliances in the region, within the Gulf region, but even in the region beyond the Middle East. I think there are more countries around the world that unfortunately are also facing economic challenges erupting out of this war. You've got countries such as Philippines, countries such as Nigeria, even countries in the United Kingdom and France, where people are imagining that if the blockade and the disruption of the movement around the Strait of Hormuz continues until winters, people can't imagine how the gas bills would be spiking.
It's a good point to make. I mean, we're seeing energy majors and regional airlines recalibrating for lower volumes and higher insurance premiums. From I guess, a UAE perspective, for a mid-sized startup or an SME here, I'm interested in your opinion on the most important defensive move they should be making right now to survive a more prolonged period of regional instability.
I think the UAE and many other countries in the Gulf are imagining an existential viewpoint here in the future. Now, if we were to take a step back, and as previously mentioned, the Gulf have had their share of differences with Iran throughout history, with some countries having to improve its relations in a much more direct way, and others keeping it stalled in a different way, despite having some strong economic relationships and investments from and to Iran, in the case of the UAE and Iran today, which is why many of the Iranian attacks against the UAE came as a surprise for many economic analysts, given that Iran has some of its largest assets outside the country within the UAE financial sector. I think the Gulf security framework is imagining itself in the future between perhaps two different ideological schools of thought. But before looking at that long term, we need to imagine short term, is that most Gulf allies are supporting the idea of an urgent solution and an end to the war at any cost. And then we might derive into looking into these diverse approaches, where some might be promoting a stronger ideological school of thought, referring to the deterrence camp, which is closer to the UAE approach. Could have been closer as well to the Saudi Arabian approach, but the Saudis may have moved towards some form of imagining better tools of diplomacy, given the mistrust towards the US. As previously mentioned, many of these Gulf allies believe that their long-standing relationships by the United States, economically, politically, and militarily, hasn't been recognized enough when this war was conducted. And then you've got the other school of thought within the Gulf, which is closer to the Qatari and the Omani school of thought, which wants to promote diplomacy as a final and permanent solution in this regional neighborhood, which includes themselves and Iran. However, what's even complicating that school of thought, and there has been public statements by the Qatari Foreign Ministry and by many countries in the region, even beyond the Gulf, that have advocated for the importance of mediation efforts, is the continuity of the Iranian attacks against these countries, despite claiming that it wants to build permanent brotherly, quote-unquote, relations with these countries. The issue we have here is that Iran views these countries as part of an overarching pretext of US influence in the region, which is why we're imagining that it will be leaving a permanent scar in the relationship between both Iran and the Gulf. Hence, it'll be very difficult to imagine that the permanent relationship will survive and be sustainable.
In your research, Dr. Zainon, you've looked at how nations try to keep economics separate from politics. Given this current crisis, to what extent can the private sector in the Gulf decouple from the geopolitical shocks that we have seen and are continuing to see? Or is the integration too deep?
The integration is certainly too deep institutionally if we were to look at it in the short term. But in the long term, I think there will be a lot of strategic evaluations. I think what will be noticed is that once notified that this was a part of the region where there was a strong focus on natural resources on one hand, but also a strong focus on sectors such as tech, AI, edtech, entertainment, the sports industry, tourism, culture, and arts. And it should continue to put these efforts into it, given that this war shouldn't, and we never hope for it to continue and last permanently. But I think there will be now a very strong focus into integrating and implementing geopolitical security frameworks into these fields. We've already noticed a strong interest by many of these Gulf countries in investing in private educational institutions that would teach international relations, politics, military studies. I think what we are imagining now, especially given that there are many political elitist conversations, and some of them have been perceived by the regional media, is that many of these Gulf countries now are imagining a future a relationship between an imagined political community that unifies the GCC. We've all known that the GCC has always been one of the most successful unified bodies in the region, but given the recent share of differences they have been facing even prior to this conflict, it does come as a surprise, which is perhaps one of the most optimistic results that did derive and emerge out of this crisis, is that now they're realizing that they may want to create a stronger collectivity that would ensure that it could protect their collective existentialism, which was collectively threatened by this war. I think many multinational companies and strategy houses will now feel more confident in pitching ideas about how to support and enhance these countries' risk assessments and risk preparations and frameworks and institutional muscles when it comes to their geopolitical security frameworks.
The headlines focus on oil strikes, oil prices and military strikes. What's the silent economic impact that you're tracking? Is it a drop in FDI? Is it perhaps a change in, I don't know, the talent migration patterns that have historically fueled the growth in the Gulf region?
So one cannot deny that a lot of countries in the world, whether it's Russia or China or even arguably the United States, as per Trump even stated, that his economy would be able to provide the alternative oil that wouldn't be able to be found from the Gulf in the same expected timeline by many of their client economies around the world. There's an interesting issue here is that, and if we look closer into the oil industry, is that if you represent a country that has had an agreement with a country that I controlled for the past 40 years, and suddenly I'm not able to provide you that oil due to a disruption of routing or trading or movement, it doesn't mean you can find that alternative to suit you immediately, because not all oils are the same. The oil in Saudi Arabia, the oil in Iraq, the oil in Libya, the oil from Russia, the oil from other countries around the world are different. Hence, they're used for different purposes around the world, which means that many of these economies might try to find temporary solutions or even wait for some of these economic allies and partners that they have established a long-standing economic trading partnership with for a very long time. We can also imagine that there might be other businesses and there might be other economic inventions that might erupt out of these conflicts. There might be industries that will be discovered. There might be other products and goods and services that might find themselves being discovered by these regional economies, discovered by many of these trading routes around the world as an alternative. Some of them might jump into the picture as a temporary alternative and find themselves becoming permanent solutions based on common interest between the seller and the buyer. This might be a very optimistic point of view, but one cannot deny that many of these crises in history, in contemporary history, especially in this part of the world, has been the perfect opportunities for business investments to notice new elements that could benefit their business and economic relationships with the agencies they deal with in the countries.
So with that in mind, what signals should businesses be watching in the coming weeks?
Alternative services and goods that could be delivered that weren't be able to be delivered. Alternative routes to the Strait of Hormuz, which do exist around the Sea of Oman, around the Red Sea next to Saudi Arabia. There has been a lot of discussion about a route that connects movements between the GCC, Iraq, Syria, and Turkey. Obviously, it wouldn't fill the gap immediately. The global economy's 20% reliance on the movement on natural resources has been through the Strait of Hormuz. So neither the economy of this region or the rest of the world will be able to fill that gap immediately. However, if the crises were to be continued and the disruption of the movement of goods and services to the Strait would be continued and impacted by the continuity of this conflict, alternatives will be discovered in one way or another. That's always been the case in world history, where the consequences of political developments, if it were to be permanent, it does not mean that the economic consequences were to be permanent. There will always be an alternative solution that will fill it.
Can I ask you for an opinion, I guess? Project our situation 6 months from now to, let's say, the new year, into January 2027. What seems to you to be the most likely reality? Are we living with a manageable tension, or should businesses be, stress testing balance sheets for a not quite such an agreeable scenario?
I think, and this perhaps will make it easier to look at it from a distance for many business investors, is that the current level, the current military level, the current status quo, the geopolitical status quo of the conflict as it is today wouldn't continue. The United States cannot afford it. Iran can't afford it. Even Israel, that has been very open about wanting to continue this conflict, regardless of the U.S. approach, regardless of the progress between the U.S. and Iran talks. The current status quo of this war wouldn't continue as it is, but I think the regional rivalries led by both Iran and Israel, as an attempt to proclaim their positions as regional powerhouses, would continue, which means that it will be a huge difference between the implications to the micro level and macro level businesses and economic opportunities in the region. Do I believe that they will be able to revamp themselves and integrate and adopt into the new situation to ensure that business as usual would continue, but in a much different way? Yes, certainly. I think the region has faced bigger economic consequences and challenges, including the global economy, many decades before.
Dr. Zaidan Al-Kinani is the founding director of the Arab Perspectives Institute. I must apologize for our delay in getting to you this morning, Dr. Zaidan, but we did get there in the end. Thank you very much for joining us.
Thank you, sir. Appreciate it. Have a good one.
As always, don't forget to like and subscribe for more interviews like this from Mira Business FM.
Mira Business FM, Dubai's home of business radio. Mira Business FM, Dubai's home of business radio.
This is the Morning Drive at Mira Business FM. Good morning to you. The UAE's anti-money laundering law, what every business needs to know in 2026. Here's the background. In October last year, the UAE completely overhauled its anti-money laundering legislation, Federal Decree Law number 10. Now, 2026, the weight of that law is being felt by businesses across the country. There is increased liability for managers, potentially some large fines on the line. So ignorance, of course, is no longer an option, not that it ever really was. Here to explain how you can protect your business is Raymond Kismani, a partner at Davidson & Co. Joins us on the line. Raymond, good morning.
Good morning, Tim. How's it going?
Very good, thank you. Good to have you back on. Nice to see you. Looking very resplendently lawyery, we were commenting off air just now there.
Well, I mean, sometimes I try to wear something that has buttons on it.
That's probably more information than I needed, but good to hear. Raymond, good to talk to you. We've kind of mentioned the anti-money laundering law in passing. We've not really looked at this in detail, and I want to do that today with you. Can we start with perhaps the single biggest change, which is the standard of knowledge? And under the old law, you had to actually really know that funds were linked to crime. Now, the test is you reasonably should have known. In plain terms, what does that mean for a business owner?
Yeah, I mean, I know that sort of sounds like legal terminology, but I mean, the practical difference is really enormous here between actual knowledge versus reasonable knowledge. Previously, regulators, courts, etc., generally needed to show that someone actually knew the money came from criminal activity or was involved in criminal activity. Now the question becomes significantly broader: would a reasonable, quote unquote, reasonable person looking at the circumstances in the same situation have recognized that something wasn't right? So we've changed the legal test from a subjective one to a more objective one, if that makes sense. So, in other words, businesses can't rely on saying, well, nobody specifically told me that they were involved in a crime. If there were obvious warning signs that should have prompted further questioning, failing to investigate those signs now creates liability. So it raises the expectations that businesses actively identify risk rather than simply reacting to confirmed criminality, if that makes sense.
It does. I mean, give us an example. Let's take the example of a real estate broker takes a payment from a new client with an opaque corporate structure, let's say. How does their exposure change under the new law?
Yeah, so I mean, if we were to imagine a situation where you get a buyer who wants to purchase, several million dirhams worth of property. They want to do it through multiple offshore companies. They don't explain the ownership structure of these companies. They want to move unusually quickly. They kind of provide inconsistent or no information about the source of funds. That kind of set of circumstances previously, some businesses might have simply kind of completed the transaction because there wasn't something kind of smacking them in the face that something proved actual criminality. Today, if you're faced with any one of those situations that I kind of mentioned in the example, if you leave those unanswered questions and sort of just kind of turn a blind eye, if you will, that can become a real issue. If the circumstances would cause a reasonable professional in your place to stop, to investigate, to file appropriate reports, to ask some questions, kind of simply proceeding with a tick box approach creates significantly greater legal risk for yourself and for your organization.
Okay, so now deliberately not asking questions, willful blindness, if you like, is that effectively a crime in and of itself now?
Yeah, you can't sort of do the kind of burying your head in the sand and pretending that you don't see things that are going to raise some red flags. So it's certainly far more dangerous than it used to be. It's quite an important indicator here that the law isn't criminalizing curiosity or making innocent mistakes illegal. But if you are deliberately avoiding information because you don't want to know what the answer is, you don't want to be burdened with the knowledge of the answer, that's no longer a safe strategy. Again, it's that kind of willful blindness, burying your head in the sand, whatever you want to call it. So if someone is intentionally ignoring obvious warning signs, or they should have not ignored those warning signs, a court or regulator is much less likely to accept the argument that they genuinely didn't know. Businesses now have a more positive obligation to engage with the risk, to ask questions, to follow procedures, not to just avoid asking those questions altogether and just kind of hoping for the best.
Who decides what someone reasonably should have known? Is there guidance, or is this just going to be, case by case, and it will be tested that way?
Yeah, I sort of laugh because I think anybody that has spent more than 10 seconds in law school will have sort of been hammered with what is the actual definition of reasonableness?
Yeah.
Because it's obviously it's a much more objective question, but obviously reasonableness depends on the profession that you're in, the kind of the guided circumstances you're in. Ultimately, this is a legal question that is going to be decided by courts that are examining the behavior. They will look at the surrounding circumstances of the situation. They'll look at the person's experience, their role, the industry that they're operating in. What are the norms of that industry? What internal policies were in place? Were those policies followed? Were the warning signs present? Were questions asked? It's also so it's a bit more of a holistic approach to this. Because if you're operating in real estate, it's going to be different than if you're operating in a hedge fund, and it's going to be different than if you're operating in a sort of precious metals, etc. The other important aspect to recognize here is that regulators take great pain to publish guidance for different sectors as to what the expectations are. So there are common principles. But the assessment is always going to be highly fact specific to the situation, to the person involved, to the industry involved.
Okay, so a term that's new to, I guess, most of us is proliferation financing. This is now a standalone offence. It's on par with the money laundering, the act of money laundering itself. What is proliferation financing, and why has that been elevated in the UAE?
Yeah, so proliferation, it's a bit of a mouthful. Proliferation financing. Try saying that 3 times fast. It refers to funds or financial services that support the development of weapons of mass destruction, so things like nuclear, chemical, biological weapons. Historically, those have always been alongside more standard sanctions compliance. But the UAE has now elevated it because international standards have evolved over the course of time, particularly through the Financial Action Task Force. So with the UAE's role, especially as a global financial and trading hub, authorities expect businesses to actively identify and mitigate this risk rather than treat it as oftentimes somebody else's responsibility to look at.
Okay, so what does proliferation risk, proliferation financing risk actually look like in practice? What are the red flags, Raymond?
Yeah, I mean the reality is, and I think fortunately is that most businesses will never encounter this directly, but it's important to have kind of internal policies around what to look for. But certain industries are obviously more exposed to it than others, obviously.
Yeah.
But indicators might include unusual trade routes, for example, customers connected to sanctioned jurisdictions. If you're in a logistics type industry and you find complex international shipping arrangements, shell companies that don't have any obvious commercial purpose, or transactions that are involving sensitive goods that don't really match the customer's stated business. Um, you know, the point isn't that these automatically indicate wrongdoing. They are simply things that seem off. It's more oftentimes it is a transaction that doesn't follow the typical mold that you are used to in your industry, that should give you a bit of a red flag and a bit of pause that you might want to escalate that risk profile.
Let's talk about personal liability. One of the headline points here is potentially fines, and the fact that managers can face criminal charges in certain circumstances. Who is potentially in the firing line?
So it's quite a wide range. I mean, typically people think that it's only the top CEO, but it can extend beyond the CEO and even beyond the money laundering reporting officer, the MLRO. The law focuses on individuals who actually exercise management or supervisory responsibility within an organization. So that could include people like directors, executive partners, and even department heads, depending on the role within the organization. As sort of a general rule of thumb, the higher your decision-making authority is, then there's a greater expectation that you ensure that appropriate compliance systems exist and that they are followed and they're operating effectively.
What triggers liability? Does it need to be that it's proven that you were actively involved? Is it failure to offer adequate supervision?
Well, I mean, really kind of anything that falls short of you failing to implement appropriate controls, ignoring compliance failures, or that you are simply failing to supervise where there was a clear responsibility for you to do so. Those are things that are going to expose management to liability. The focus is increasingly on governance and on accountability. So the leadership of an organization can't simply assume that compliance is kind of concentrated and is somebody else's job. It is a holistic organization-wide effort.
And what about penalties? I mean, I'm reading here, and I don't know if these are accurate, but it's hefty: 5 to 10 years in prison, personal fines as high as 50 million dirhams. I mean, that's the UAE at certainly the tough end, isn't it?
Absolutely. I mean, the penalties are certainly substantial and they're not a joke. It's really important to remember that the UAE is aligning itself with international best practice rather than sort of operating in isolation. Globally, we are seeing a trend that regulators and governments are increasingly expecting meaningful enforcement rather than just sort of symbolic enforcement, symbolic penalties. So the message globally, but certainly within the UAE, is that financial crime presents a systemic risk to the entire economy, and that serious breaches will attract serious consequences.
Can we talk sectors for a minute? So, financial services, I don't know, legal, accounting, virtual assets. and real estate, which this program covers quite closely. What does the new law mean for brokers, for developers, for agents?
Yeah, so I mean, a bit like when we were talking about reasonableness, that it things tend to be business specific and sector specific. Real estate remains one of those sectors that regulators watch particularly closely, especially within the UAE, since it is quite a substantial sector within the economy. Businesses should expect greater scrutiny around things like beneficial ownership, source of wealth, source of funds, people that are politically exposed persons, and just generally unusually structured transactions. The expectation isn't that agents or brokers or anybody is going to investigate every single client like they are, conducting a police level investigation, but it's that they ask appropriate questions, they follow internal procedures, they document the answers, and they escalate concerns where things are necessary to escalate.
Okay. What about the gold and precious metals trade? I mean, obviously core to the UAE, Dubai, the city of gold. What about changes for dealers in those trades?
Yeah, so I mean, this is one of those sectors that has long been recognized internationally as presenting elevated money laundering risks for obvious reasons. The practical expectations are stronger customer due diligence, and closer monitoring of high value cash transactions, verifying beneficial ownership, and keeping a very careful record keeping. The sector already has been operating under significant obligations, but now the consequences of getting compliance wrong has increased.
What about crypto? We should mention crypto, shouldn't we? I guess, as the UAE becomes a center for cryptocurrencies. Does this raise the bar beyond what VARA already requires?
Yeah, so this is a really interesting one because I mean, as you very correctly mentioned, I mean the UAE is very quickly I would actually argue that the UAE already has become a global hub for all sort of virtual asset led transaction. VARA already, VARA being the Virtual Asset Regulatory Authority, which operates for Dubai mainland, they already impose a very sophisticated AML requirement regime that already exists. The new federal law does not replace those sector-specific obligations, but it reinforces them, and it sort of adds on to them. So virtual asset service providers, VOSPs, need to ensure their internal controls, their blockchain monitoring, their sanctions screening, and their governance arrangements meet both the VARA expectations and the broader federal AML framework. It's really yet another reminder for UAE crypto businesses that the expectation is that they operate with compliance standards that are actually comparable to traditional financial institutions.
Okay. Final, in terms of sectors, final one. What about law firms and accountancy practices? Those professionals, very much like yourself. I'm not lumping you in here in any way, but you know what I mean. Professionals who see themselves as you work in an advisory capacity.
Yeah, exactly. I mean, law firms like ourselves, accountants, obviously. I mean, we are quote unquote professional advisors. We are considered gatekeepers, meaning that law firms like ourselves, we frequently kind of our bread and butter is establishing new companies, advising on corporate transactions, handling client funds, structuring investments, dealing with investors. All of those activities can present money laundering risks. And the kind of the old-fashioned professional privilege is not a substitution for compliance. Where AML obligations apply, they have to be taken seriously. And pretty much anybody that has dealt with our law firm knows that no matter how urgent your transaction is, no matter how many times that we've probably dealt with us, we still have to follow these regulations. We have to ask these questions. We have to confirm who you are. We have to do all of these things, both for our protection in terms of money laundering, but oftentimes for the protection of the client, because there's obviously a heightened risk of cyber attacks and hacking and whatnot. So it's not just acting as a gatekeeper and acting in terms of money laundering risk, but there's added protections for the actual clients themselves.
Here we are. We're just over halfway through 2026. The regulations have been enforced since December. If a mid-sized company still hasn't updated its anti-money laundering framework, what's the order of affairs, the order of operations?
Yeah, I think that there's probably about 4 or 5 things that you should do as quickly and as proficiently as you can. I would say the very first is update the enterprise, the organization-wide risk assessment. This is understanding what your business lines are, what your risks are to enabling money laundering and AML issues. So kind of an assessment of your organization and what risks you have. Secondly, based on that risk assessment is then revising your policies and your procedures and applying that to the customer due diligence process that you have to follow for each new client that you are onboarding. And then obviously training your staff based on that assessment, based on that revised policy and procedure, based on that due diligence process, making sure that your staff is trained on how to do things in the day-to-day course, when to raise their hand that there's an issue, etc. And then finally, I would say is that you have to test whether this framework that you've created actually works in practice. Many businesses kind of take a great deal of time and a great pains to do all this assessment, to put together these policies, and then they sort of just sit on somebody's shelf or drawer or in somebody's kind of computer file. So it's not just about having the policy, having the greatest policy in place. It's actually, are you implementing it day in and day out with every single customer or client? And are you following enhanced procedures and raising issues where you're seeing red flags?
Okay. What about if you're a smaller business, Raymond? You don't have a compliance department. Is outsourcing realistic? And what does that mean for liability if you do outsource?
Yeah, I think this is hugely advisable for startups, small businesses, kind of even to sort of mid-sized industries, because as you can see, this framework is quite comprehensive. It is time consuming, and obviously businesses are in the business of trying to get customers, trying to get clients in. So you might not have the bandwidth, the funds, etc., to be able to deal with all these compliance. So outsourcing is absolutely realistic and very often a sensible solution. There are external specialists that can provide expertise that smaller businesses simply don't have internally or don't have the funds to it. But it's really, really important that you understand that outsourcing responsibility is different than outsourcing accountability. So if regulators are investigating, the business and the management remain responsible for ensuring that the outsourced compliance is actually being done, being followed, that they're getting those kind of regular reports from the outsourced compliance.
Okay. On enforcement, has it been gradual so far in terms of the approach? Are there any test cases that we can learn from or refer to?
Well, I mean, it's quite clear that authorities have clearly demonstrated that enforcement is real. We've already seen administrative penalties and regulatory action and just kind of an increasing in supervisory activities across various sectors. As businesses become more familiar with the new regime, I expect regulators to place even greater emphasis on demonstrating that non-compliance carries real consequences. And again, the key here isn't just to have the perfect policy written down, but it's actually, are you implementing it day in and day out?
I feel like we've at least scratched the surface today of this. I'm just wondering, is there anything I've forgotten that I should have brought up with you, Raymond?
Well, I mean, I think one of the few things that we can kind of discuss is a lot of times when people hear AML or compliance, they often think about it, or KYC, they often think about it as being sort of isolated to banks or to financial services firms. Still, even with the old regime that's been in place for over 10 years, we as a law firm kind of often do get pushback from clients of like, oh, why do I need to do KYC? I'm just trying to buy a few properties or establish a company, et cetera. And so I think that there's a misconception that KYC, AML, all these things only apply to banks or to really large organizations, but kind of failing to understand that it really applies to a whole lot of industries. And that net is becoming wider and wider. Even with sectors such as crypto and virtual assets, which are decentralized, kind of they sit outside the traditional financial sector. There's kind of a leanness to it. So I think that's one area where people can sort of get their heads around. And I think the other one is, it's all well and good having a terrifically well drafted. I know that I've said this about 4 times so far, but it's not about having the perfect policy in place, but it's actually making sure that you're reviewing it constantly and updating it constantly, making sure that your staff is trained on it and is following it, and making sure that it is just being followed day in and day out.
Would that be like the final thought? If there was a message for anybody, I was going to say business leaders, but for anybody watching or listening to this, that it is about awareness, it is about being on top of these things, and it is about understanding that if it doesn't feel right, it probably isn't right.
Yeah, I mean, or certainly it's that if something seems out of place, something is out of ordinary, then questions should be enhanced, things should be escalated.
Yeah.
AML compliance is a governance issue for the vast majority of businesses across the UAE. I mean, basically, if your company, if your organization handles customers, money, assets, transactions, you're handling client funds, any of those sorts of things. I think a central question that you need to ask yourself is, can you demonstrate to a regulator today that you have an AML framework and it is being operated and it genuinely works? If you can't answer that with a very confident yes, now is the time to fix it before somebody else than yourself asking that question is actually posing that question.
For sure. The UAE's anti-money laundering law, federal decree, law number 10, and it's now in effect. A complete overhaul of the previous regulations, what every business needs to know. Raymond Kasmani is a partner at Davidson & Co. It's always a pleasure to have you on the show, Raymond. Thank you again.
Thanks so much, Tim.
Good to have you with us. If you have a question for any of our guests here at Mira Business FM, legal or otherwise, drop it in the comments.
Mira Business FM, Dubai's home of business radio.